How does a company report a $43 million net loss for the quarter, take an $84 million hit in write-downs and asset impairments, and yet they confidently announce their 56th consecutive annual dividend increase?
Yeah, that contradiction right there, that is just the perfect entry point. Because, it tells you there is a highly complex, almost counterintuitive financial mechanism operating right beneath the surface of those headline numbers.
Welcome, everyone. Thank you so much for coming to watch the video today. We really appreciate you spending your valuable time with us.
Absolutely. Thanks for being here.
So today we are unpacking Universal Corporation's fiscal 2026 earnings, and our mission is really to break down their $2.9 billion fiscal year, understand this massive structural shift happening in global tobacco right now, and look at the growing pains of their new ingredients business.
Right, because we are essentially looking at how a century-old legacy business tries to buy its way into a very modern, trendy market. And, well, what happens when reality just doesn't match the spreadsheet?
Exactly. So let's just start with the financial reality check, the prepared presentation. Universal Corporation finished fiscal year 2026 with consolidated revenue of $2.9 billion.
Which is actually down slightly from the prior year.
Right, down slightly. But the operating income, that took a brutal hit. It dropped by $64 million, landing at $169 million. And almost all of that pain was violently concentrated in the fourth quarter.
Yeah, and that Q4 is fascinating because if you were just, glancing at the top line for Q4, you might think things were cruising along normally. Q4 revenue is actually up 2% year over year to $715 million.
And selling more volume is usually a reason to celebrate.
You would think so. But then you drop down to the bottom line, and that same quarter produced an operating loss of $15 million and a net loss of $43 million.
I just want to pause on that for a second. Because on paper, selling more stuff but suddenly losing tens of millions of dollars doing it, it sounds like a catastrophic operational failure.
It does. It sounds like the wheels are falling off.
Right. So I was trying to wrap my head around how this happens. And the best way to visualize Universal's current situation is imagine buying a famous high-end restaurant.
Okay, I like this.
So you didn't just pay for the physical ovens, right? The tables, the building. You paid millions for the prestigious brand name, the loyal customer base, the expectation of future profits.
The intangible stuff.
Exactly. But if nobody books a table for a whole year, accounting rules literally force you to admit that the prestigious brand name isn't actually worth what you paid for it.
Right, you have to adjust the books.
And while you're standing in this empty dining room dealing with that realization, you open your walk-in fridge and you discover that the incredibly expensive truffles you bought months ago are expiring and losing their value.
That captures the mechanics beautifully. Because the losses Universal reported in Q4, they were not from cash just bleeding out the door in daily operations.
They weren't just burning cash.
No. They were driven by two massive non-cash accounting charges. So let's start with your high-end restaurant analogy, which is the Shank's ingredients business.
Right, the acquisition.
Yeah, Universal acquired Shank's back in October 2021. It was part of this broader strategy to pivot into plant-based ingredients. And when you acquire a company, the premium you pay over the raw value of its physical assets, that gets recorded on the balance sheet as an intangible asset. It's called goodwill.
But the accounting standards dictate that you can't just leave that goodwill sitting on your balance sheet forever, pretending everything is totally fine, if the business isn't actually generating that expected value.
Exactly. You are required to periodically assess it. And for fiscal 2026, Universal had to take a $41 million non-cash goodwill impairment on Shank's.
Wow, $41 million.
Yeah, they essentially had to write down the value of their own acquisition. And the underlying why here is really the interesting part. Because Universal has been pouring capital into Shank's. They funded new production capabilities. They hired commercial and R&D talent.
So they built the infrastructure.
They did. They built this robust infrastructure, anticipating rapid growth. But they're learning a very expensive lesson about the customized ingredient space. Converting initial customer interest into sustained high-margin revenue is a painstakingly slow process.
Well, let's push on that a bit. Because are they just hiding a flawed acquisition strategy behind the excuse of, long sales cycles? A $41 million impairment makes it look like they wildly overestimated the market.
It's a fair question.
Yeah.
You have to remember, they are trying to sell B2B customized solutions, which is a totally different DNA than their legacy business.
Right. Their legacy business is just moving massive amounts of tobacco.
Exactly. Selling bulk agricultural commodities is a volume and logistics game. but selling customized, plant-based botanical extracts to a food or beverage manufacturer. That requires collaborative R&D.
Oh, so you're actually co-developing a product.
You are co-developing a specific flavor profile or a functional ingredient for a product that might not even launch for 18 to 24 months.
Wow, that is a long runway.
Right. And while Shanks is waiting for those long R&D cycles to actually turn into purchase orders, they are simultaneously getting battered by current market headwinds. Inflation, higher fixed costs from all that infrastructure they just built.
So the revenue simply isn't there yet to cover the overhead, which forces the impairment.
Exactly.
Yeah.
Which brings us to the truffles going bad in the walk-in fridge, the legacy side of the business.
Right, the second massive hit. An inventory write-down of $43 million, which was concentrated heavily in their non-wrapper, dark, air-cured tobacco.
Yeah.
And just to frame how massive that is for anyone watching, from 2021 to 2025, their average annual inventory write-down was about $14 million.
Right.
So jumping to $43 million is a total shock to the system.
Right.
So what exactly is dark air-cured tobacco, and why did its value suddenly crater like that?
Well, to understand the mechanics of this write-down, we really have to look at the global tobacco ecosystem. Most people know flue-cured and burley tobacco. Those are high-volume, lighter tobaccos used in traditional cigarettes.
Okay, the standard stuff.
Yeah. But dark air-cured tobacco is a much more niche, specialized crop. It's heavier, it's fermented, and it's used for cigars, chewing tobacco, premium cigar wrappers. And the critical distinction here is the grade. Premium wrapper grades command top dollar.
But if you have non-wrapper grades, which is essentially the filler or lower-tier leaf, its market is way narrower.
Way narrower. So if consumer demand for specific types of cigars shifts, or, if a crop yields an unusually high percentage of lower tier leaf that just can't be used for wrappers, you are suddenly sitting on a mountain of inventory that nobody wants to pay top dollar for.
And that triggers a strict accounting rule, right? The lower of cost or net realizable value.
Exactly. Universal conducts these rigorous deep dive reviews of their inventory. They look at what it costs to acquire and process that specific dark air-cured tobacco, and they compare it to what they realistically believe they can sell it for in today's shifting market.
So because the estimated market value for this specific inventory dropped below their cost basis, they are legally required to recognize that loss on their books immediately.
Right. Even before they physically sell the leaf. They essentially took all their medicine at once in Q4.
Got it. But before we get to how the analysts reacted to this, let's briefly touch on the forward-looking guidance and strategic comments from the presentation, because it wasn't all doom and gloom.
No, there were definite silver linings.
So their net debt is currently at $845 million, which is up, but they have liquidity exceeding $1.2 billion. Plus, management expects their uncommitted tobacco inventory to drop back to their target range of 10 to 20% in FY 2027.
Which is a very healthy sign.
And they acknowledge the global oversupply in flue-cured and burley tobacco, but they plan to navigate this using geographic diversification. Also, they're doing a leadership realignment as Shanks.
Shaking things up there.
Yep. And notably, they achieved an A rating in the Carbon Disclosure Project's Supplier Engagement Assessment. Oh, and of course, they appointed Steve Dial as the new CFO.
Yeah, a lot of moving parts.
Right. Now, we are about to dive into the Q&A session where the analysts really put the executives on the hot seat. But before we get into that high-stakes grilling, if you're finding this breakdown of corporate strategy and financial maneuvering valuable, please click like, share this video, and hit subscribe so you don't miss our upcoming content. It really helps the channel.
Yeah, please do, because, in these earnings calls, the prepared remarks we just went over, that's just the polished narrative. The real insights happen when the analysts actually start poking holes in that narrative.
Exactly. So let's get right into the Q&A session. For each of these, I'll give you the analyst's name, their firm, and what they asked, and then we'll summarize the company's response.
Sounds good.
All right, so question number 1 came from Daniel Harriman from the firm Sidoti. He basically asked about management's confidence that inventory will actually normalize in FY 2027. He wanted to know if there's further write-down risk in that dark air-cured tobacco and how the underlying business, like the flue-cured, the burley, the ingredients outside of Shanks, is actually performing beneath all these crazy accounting charges.
Yeah, that was a loaded question.
It was, and I actually want to push back on something here, too. Are they just crossing their fingers that the market improves, or is this oversupply actually a secret advantage for a buyer like Universal?
Well, it's definitely the latter, and that's exactly what CEO Preston Wigner and CFO Steve Deal emphasized in their response. They are highly confident in inventory normalization. And they aren't just guessing. They're already seeing early crop movement in Brazil.
Right.
And regarding the write-downs, they stressed that Q4 was a very rigorous, conservative deep dive. They did the lower of cost or net realizable value review, and they feel very comfortable with current inventory levels. They don't foresee more massive hits there.
And what about the oversupply question?
This is the fascinating part. Universal actually likes large crops.
Really?
Yeah. Having 100 years of experience means they know exactly how to buy the right grades at the right prices during an oversupply. It gives them way more flexibility than when the market is undersupplied and everyone is panicking to get product.
Wow. So having 1.2 billion in liquidity means they can just sit back and cherry pick the best deals.
Exactly. And to answer the last part of his question about the ingredients business outside of Shank's, companies like FoodSmart and Silva Management said those are meeting expectations. And they noted that if tariffs ease up, that could really boost future volumes for those segments.
Okay, so that leads right into question number 2. This was a follow-up from the same analyst, Daniel Harriman from Sidoti. He asked for a reminder on the company's capital allocation priorities. Specifically, how do they balance this legendary dividend, their leverage, and the continued investments into the ingredients platform?
Yeah, and Steve Dale was very clear here. He outlined their 4 pillars. Number 1 is investing in leaf tobacco. Number 2 is increasing the dividend. Number 3 is exploring plant-based ingredients growth. And number 4, dead last, is share repurchases.
That dividend priority is wild to me because their payout ratio on reported net income exceeded 100% this year. In almost any other scenario, that is a massive red flag.
It is the ultimate red flag for an income investor. But here is the secret, and Steve Deal clarified, this cash flow is king. Accounting losses, like that $41 million non-cash Shank's impairment, do not equal cash leaving the checking account.
Oh, right, because they didn't actually write a check for $41 million.
Exactly.
Yeah.
So if you look at their adjusted net income, their historical payout ratio sits very comfortably below 75%. The cash is still flowing in from the tobacco side, so the dividend is incredibly safe.
And what did they say about investing more in the ingredients platform? Are they still looking to buy companies?
No, management explicitly stated that M&A for ingredients is completely paused. They are in what they call the realizing returns phase for Shank's.
So they basically have to prove they can run the restaurant they already bought before they're allowed to buy another one.
That is exactly it. Because the core tobacco business is so durable and generates so much cash, it remains the absolute top priority for capital investment.
Okay, so the third question. Daniel Harriman from Sidoti had a second follow-up. He asked Steve Dial how his experience at Universal since he's been there since 2018, how that prepares him for the CFO role, particularly regarding how he's going to communicate the long-term value of this ingredients platform to outside investors.
Yes, it's laid out a 4-part philosophy here. The first is financial stewardship, which is your compliance, tax, and audit stuff. Second is financial excellence, continuous improvement, and capital optimization.
So keeping the house in order.
Right, table stakes. But the third part is executing the dual strategy, which means maximizing the tobacco business while growing the ingredient side. And the fourth, and definitely the hardest part, he called telling the story.
Which is an incredible challenge. I mean, you have a century-old tobacco leaf buyer trying to convince the market that they can successfully transform into a modern, dual-engine agricultural products powerhouse.
It's a very tough narrative to sell
When
your flagship ingredients division just forced you to take a $41 million write-down.
Absolutely. So to wrap this all up at a high level, we've seen that Universal Corporation is navigating a massive global transition from tobacco undersupply to oversupply, and they're dealing with the painful realities of scaling an acquired ingredients business.
Right. But they are leveraging a century of supply chain expertise. They have ruthless financial discipline, conservative accounting, and they're doing all this to protect their balance sheet and their legendary 56-year dividend streak.
It really is a masterclass in using your legacy strengths to weather a transition.
It really is.
Well, thank you so much, everyone, for watching the video today and exploring this really intricate financial landscape with us. We deeply appreciate you spending your time here. If you enjoyed this analysis, please click like, share the video with fellow learners, subscribe to the channel, and stay tuned for more content coming soon.
Yes, thank you for watching. Looking past the surface level numbers is really the hallmark of a great analyst.
Before we go, I want to leave you with one final thought to ponder. Universal's superpower is its 100 years of deep relationships in the global tobacco trade. But as they pivot toward clean label, plant-based ingredients, a market with vastly different customer behaviors and totally different innovation cycles, are they underestimating the massive cultural shift required to sell customized solutions rather than bulk commodities?
Mm.
Will this side hustle ever truly rival their core business? Or is the 100-year-old leaf still the only crop that actually matters? Think about it.